part 2. We're going to talk about dividends. So if you've watched my first video, there was no sound, so hopefully this one saves sound. Anyway, we're going to start here. This is on page 5 of your handout, so it should be halfway through, although this one's a little bit shorter. So we're going to talk about dividends first. Okay, the first thing we're going to talk about is why companies pay dividends. This is not the answer to this one, but you ought to know why they pay dividends. So don't answer it here. But basically, to maintain agreements with creditors. So if you remember the retained earnings, beginning retained earnings plus net income minus dividends equals ending. So sometimes we talked about the bond covenants or debt covenants in the prior chapter. So you might have a debt covenant that says you have to have so much retained earnings available. State and corporation laws might require a certain amount of retained earnings. You might want to keep some earnings to finance growth or expansion, to smooth out dividend payments. So a lot of companies don't necessarily want to pay out their dividends each year because they want their dividends to look kind of like that. So they would grow at a steady rate, but your net income may be fluctuating up and down. So I may just keep a stable dividend policy where I pay out 20 cents a share, 15 cents a share, next year 16 cents a share, next year 17 cents a share, et cetera, et cetera. The reason I do that is because a lot of people buy your stock based on the dividend it pays, especially retired people who have a certain amount of bills that they have to pay each month. So if you were an elderly person and that was your only source of income, you would certainly want to be able to do some planning. So if you want to do some planning, you want to buy a stock that pays out a dividend that you can count on. So you wouldn't want to buy a stock that pays out all their net income, and if their net income's fluctuating, one year their dividend's high, next year dividend's zero, next year it's really high, et cetera, et cetera. And then this one's sort of related to build up a cushion against possible losses. So basically, remember, it's beginning retained earnings plus net income minus dividends equals ending. So you certainly don't want your ending retained earnings to go into the negative if you can help it. A lot of times it happens in the first year of business because you add net income. If net income's a loss, you are in a negative position retained earnings. So you kind of, once you get going, you don't want that to happen. So you leave an amount in retained earnings. So make sure you know that. Notice that the SEC does encourage you to disclose your dividend policy, whether your dividend policy is to pay out a steady dividend, or if you don't expect to pay dividends in the foreseeable future. You need to say that because, again, investors buy stocks based on whether they pay dividends. Apple didn't pay dividends for a long time, mainly because if you think about it, they were financing growth or expansion. So the people that bought Apple stock knew they weren't going to pay out a dividend. Remember, there's two ways to get a return on a stock. That's a dividend or the share price goes up. So if you have a lot of growth or expansion, you're expecting the share price to go up. So those people who don't want annual dividends, who want to kind of control their taxes by being able to know when they sell a share of stock, it goes on their taxes, instead of when somebody pays them a dividend and they don't have any control over when that is. So anyway, there's actually 4 types of dividends. Cash dividends are dividends paid in cash. Property dividends are when you don't pay cash, but you pay some sort of property. Sometimes it's land, sometimes it's buildings. This is kind of usually done if you have a smaller company and you're paying a dividend and there's only 4 or 5 owners. So you may be doing that. Liquidating dividends, we'll talk about those in just a little bit, but liquidating dividends is when you're in essence liquidating their ownership. So if you think about the first few slides, when I when the company issued stock, they debited cash for, let's say, $100, and they credited common stock for its par. So let's say it was 10 shares at $10 market, so 10 times 10 is 100, but the par was 1, so I have 10 there, and I have additional paid-in capital in excess of par, whatever you want to call it, of $90. There's your entry. So when I pay a liquidating dividend, I'm giving some of this investment back So in essence, I don't unissue the stock. So if I'm paying a liquidating dividend of $50, I'm going to debit additional paid-in capital for 50 and credit cash. So giving back the owner's investment. So if you recall, you have two types of capital: contributed capital and earned capital. You can read my handwriting there. This one is a dividend paid out of earned capital. This one is a dividend paid out of contributed capital. The fourth type of dividend is a stock dividend. A stock dividend is a little bit different. So when you look at the journal entries for stock dividends, you'll notice that all of these dividends, I'm going to debit retained earnings. In financial accounting, we debited dividends, and then we close dividends to retained earnings at the end of the year. This book just skips the taking it to dividends and closing it to retained earnings and takes it straight to retained earnings. And I credit cash. There's your journal entry. So notice stockholders' equity is going down and cash is going down, okay, because I'm paying it out of the business to the owner. So the owner's claim on the business goes down and cash is going down. In a property dividend, my credit is not cash, but my credit is, let's say, land or whatever property you give. In a liquidating dividend, I'm going to credit cash, so I'm back to this one, and your debit's additional paid-in capital. So again, additional paid-in capital is owner's equity, land's an asset. So in all these cases, your stockholders' equity in the corporation is going down. In a stock dividend, you hand them stock. So I'm going to simplify the journal entry quite a bit here. I debit retained earnings. So if I paid a cash dividend, here's my journal entry. Debit retained earnings, cash. So retained earnings is an owner's equity account. Owner's equity accounts are increased with credits, decreased with debits. So my owner's equity is going down. And if I pay somebody a stock dividend, my credit is common stock. Sometimes additional paid-in capital, but I don't want to write it in there. So notice my owner's equity is going down on this side of the entry. My owner's equity is going up in this side of the entry. So you'll find out with a stock dividend, all we're doing is rearranging stockholders' equity and moving some earned capital into the contributed capital portion. So anyway, that's all that is. So make sure you know those 4 dividends. The 3 dates we've already talked about. The date of declaration, the important thing about the date of declaration, make sure you know that is the date it is recorded as a liability. Okay, now with the exception of a stock dividend, you'll find out it's a little bit different, but all the other ones, you're going to debit retained earnings and credit dividends payable. So that's the day you legally become liable to pay a dividend. Remember, you do not have to pay a dividend. The date of record is the date that whoever owns it gets the dividend, and the date of payment is where you debit dividends payable and credit cash. So basically what happens is if you declare a dividend and you own stock here, but you're going to sell it before this date, you would increase, it's kind of like the interest issued between dates on the bonds, you're going to increase the selling price because somebody else is going to get your dividend. Okay, so anyway, that's those 3 dates. All right, so let's do a couple of these. They declared a cash dividend of 50 cents a share on 1.8 million shares. So 50 cents times 1.8 million shares is 900,000. Payable to stockholders of record July 16th. I'm sorry, they're going to pay it on July 16th and record it to the record date. So right here, June 10th, declaration date. June 24th, date of record. July 16th, date of payment. Okay, P there. Okay, so I'm going to have those 3 entries in here. The date of declaration is I debit retained earnings. Again, in financial accounting, you debited dividends, and then at the end of the year, you close dividends to retained earnings. They take it straight to retained earnings. Debit retained earnings, credit dividends payable. So notice on this date, it becomes a liability. There's no entry on the date of record. I just kind of look and see who owns my stock. So if you can picture, especially back when things were done by hand. You need to accumulate who owns the stock so you know who to write the checks out to, et cetera, et cetera. And then you actually mail it out as of July 16th. So it's going to take a while to get everybody's name and address and everything else. So anyway, if I sold my stock to somebody else, I would add this dividend of $900,000. Again, I don't own all $900,000 probably, but whatever share I owned of it, I would add it to the price because somebody else, whoever owns it on June 24th, is getting my dividend. Okay, next one. We're going to do property dividends. Okay, and in property dividends, the only thing to know about property dividends is this is important. I mark it up to fair market value before I actually give my dividends. So what I like to think is the FASB treats you as sort of, you don't actually do this, sort of selling the property, then distributing the cash. So if I sold the property, I'd recognize the gain, then I'd distribute the cash. And what that prevents us from doing, a corporation from doing, is getting it off our books and giving it to a shareholder so we can move the gain onto the shareholders' books instead of our company books. So in order to prevent that, the FASB says, okay, you treat it as having sold it, and then you pretend you distribute the value of it, but we actually only distribute the property. So two journal entries, mark it to fair market value, then distribute it. Okay, so let's go to that one. So Hopkins transfers to stockholders some of its equity investments. So these are our investments in other companies. They cost 1.25, and I declared a property dividend because I'm transferring some of our stock investments on December 28th to be distributed on January 30th to stockholders of record of January 15th. So again, here's my date of declaration, December 28th, date of record, January 15th, date of payment, January 30th. The securities have a market value of 2. So the first thing I do is I mark these securities up to market. So I debit equity investments for that difference, 2 million minus 1.25, and I credit unrealized holding gain. And here's the important thing, right here. It goes on the income statement. Okay? This little statement here, you will see either income or equity. Income means it goes on the income statement. Equity means it goes in owner's equity. So you need something in your journal entry to indicate where it goes. All right, and then I distribute my dividends on debit retained earnings, credit property dividends payable. And then when I actually pay them, I think it's on the next slide, I'm going to get it out of property dividends payable and get rid of my equity investments. Okay? So I have debit property dividends payable, credit equity investments. So now I've paid my dividends and no longer have the equity investments. Okay. Next one, liquidating dividends. Again, I've already talked about this a little bit. Liquidating dividends is when I, in essence, give them back some of their contributed capital. So it's a return of the stockholders' investments. So let's go through this. They issued a dividend. So notice it still comes out of retained earnings. Let's go back. Still comes out of retained earnings. Let's go back. Still comes out of retained earnings. So all of these dividends come out of retained earnings. But this one is a liquidating dividend. So it's the credit that's going to differ. The cash dividend announced noted that stockholders should consider $900,000 as income and the remainder as the return of capital. So basically, you could do this for two reasons. One reason is you want to get the amount of stockholders' equity down. So think about it, guys. If you have a cake, and if only 2 people show up for class, you get half a cake. But if 50 people show up for class, you get 1/50th of a cake. So sometimes I want to reduce the amount of owner's equity just so the remaining people have more. And so my remaining shareholders are happy. But anyway, sometimes I would do this because maybe I have wiped out my retained earnings. So again, remember, it's beginning retained earnings plus net income minus dividends equals ending. So if I have 100 in beginning, I have net income of 50. Okay, I might want to keep my ending retained earnings at, let's say 100. Okay, so I can only pay out a dividend of $50, but let's say I've always paid out a dividend of $70 and I want to keep paying out a dividend of $70. Well, in that case, I may say, okay, $50 is a regular dividend, the other $20 is a return of capital. And so I can still give people out their checks. But anyway, so I'm going to do the cash dividend announcement. Notice stockholders should consider $900,000 as income. Okay, so I'm going to take the $900,000 out of retained earnings. Okay, and I'm going to have dividends payable the entire amount, but the rest of it is a return of capital. So I debit paid-in capital in excess of common stock, or additional paid-in capital. So again, actually, I think I said it a little bit wrong. If you rewind this, debit cash, property dividends, debit, I say this wrong all the time and I don't want to start this video over. Debit cash for retained earnings, debit cash, or debit retained earnings for a cash dividend, debit retained earnings for a property dividend, debit retained earnings for a cash dividend. But the portion that's a return of capital, I still debit owner's equity, except it's going to come out of paid-in capital instead of retained earnings. And I don't remember exactly how I said that before, but I think I said retained earnings, retained earnings, retained earnings, and I meant owner's equity, owner's equity, owner's equity. Okay, so this one is the cash part's coming out of retained earnings. The return of capital part is coming out of, think about it, your journal entry when I sold stock, debit cash, credit common stock, and credited additional paid-in capital. Okay, you're not actually handing their shares back, so I still have X number of shares at $10 par value, so the only thing I can debit to get rid of is the additional paid-in capital. So you're undoing that entry for the additional paid-in capital part. Okay, then I pay the dividends, but notice I don't do anything for the date of record. It doesn't even list it. Next one. Stock dividends. Notice they wish to capitalize part of the earnings. So if you think about my prior journal entry, just want to remind you, I'm going to debit retained earnings and I'm going to credit common stock, but I can only credit common stock for the par, and then I credit additional paid-in capital. Okay, so all I'm doing here is moving it in owner's equity accounts. I have a credit balance, decreased on the debit side. So all I'm doing is reducing shareholders' equity out of retained earnings and increasing it in paid-in capital. So I'm reducing earned capital, crediting paid-in capital. So I'm moving it over. So it's, notice they wish to capitalize part of their earnings, move it to paid-in capital. Kind of a confusing term right there. Okay, so now I need to know, wish I'd left my little journal entry in there, but now I need to know, all right, what amount do I debit retained earnings for? And I know common stock is par, and I know, but what amount is this at? Is it going to be market price of the stock or par of the stock? And the answer is it depends on whether it's a small stock dividend or a large stock dividend. The reason you differentiate between the two is because a large stock dividend, you are flooding the market with lots and lots of more shares, and therefore the stock price is going to plummet. All right, so let's go on there. All right, so they, Colby, let's get over here. Hopefully you made notes. If not, go back and rewind it. But anyway, Colby Corporation has, Cobella Corporation has outstanding 1,000 shares of its $10 par common stock, retained earnings of 50. They declare a 10% stock dividend. It issues 100 additional shares to its current stockholders. If the fair market value of the stock at the time of the stock dividend is $130 a share. So notice I have, here's my two questions. I have a $100 par, and I have a $130 market value. I know I issue a 10% stock dividend. I have 10,000 or 1,000 shares. 10% of 1,000 is 100. They don't always give you this number, but that's how many shares I'm going to issue. So 10% is less than 20 to 25, so I'm going to use market. So make sure you know that first. So I'm going to debit retained earnings. Okay, and then basically we said below we debit retained earnings and we credit common stock and we credit additional paid-in capital. Don't do that yet, by the way. Oops. Paid-in capital. Okay, so that's basically my journal entry, but you remember I have 3 dividend dates: date of declaration, date of record, date of payment. Okay, so since I'm not yet issuing the common stock, I can't do that one. So I do this common stock dividends distributable. Okay, so remember it's going in common stock, which is an owner's equity account. That right there, make sure you know this, that right there is an owner's equity account. It's just I haven't yet given them the common stock yet. So in this case, if you think about your definition of a liability, it's paid out with current assets. Current liability is paid out with current assets. This one's not paid out with current assets, it's paid out with stock, which is owner's equity. So basically this is an owner's equity, and then when I flip around and pay it, I take it out of an owner's equity, put it into another owner's equity, and I end up with this entry: retained earnings, common stock, additional paid-in capital, or paid-in capital in excess of par. Small stock dividend, why? 10%. 10% use market, okay? Clear all that. What if it's considered large? I don't think I do it on this, so I may have to do it. Okay, so if it's a large stock dividend, I'll just make my entries on this. I use par value. So I have 100 shares times 100, where's my par? $100 par value. So this becomes $10,000. Common stock dividends distributable is always at par, just like because I'm going to issue the stock, right, just a second, so that's a P. Okay, so basically I don't need this. Okay, so basically if this is a large stock dividend, if I considered 10% large instead of small, which I don't, by the way, but if it was large, I debit retained earnings for 10,000, credit par, common stock dividends distributable at par, and then I'd flip around and distribute them on the date of distribution. And why does this make sense? Because if it's large, I'm flooding the market with lots of more shares, and so the market value is plummeting, so trying to find the market value is pretty difficult. All right, next one. Let's get done with this. Stock splits, okay? Oh, here we're having slide 62. Okay, we'll talk about stock splits in just a second. I don't think I have it on there. Yeah, you might want to just put it down there because, or someplace here, we're going to talk about stock splits. A stock split, there's actually no journal entry made for a stock split. You simply record it in your notes to your financial statements that you did it. So basically, why do we do stock splits? Well, sometimes stock, you want your stock to trade in a trading range. And so people argue about what the trading range is, but let's say it's 20 to 80. Some people say 20 to 80, 20 to 100. You can go ask Dr. Ellison what the trading range is, but it'll be in this ballpark. It's certainly not 2,000. Okay. You can look up the price of Berkshire Hathaway. It is the one stock. It's the Rolls Royce of stocks that it trades at much above that. But anyway, the reason we want to have a trading range is just simply a supply and demand. So if our stock is 20 bucks, and you have to pay a broker a fee to buy stock, and it's a flat fee of, let's say, $100 per transaction. If you buy one stock, suddenly your stock costs you $120 to get that stock. But if you buy 100 shares of stock, it's going to cost you $2,000, and you split that $100 broker fee over 100 shares of stock, so it becomes $1 each, a broker fee per share of stock, instead of $100 for one share of stock. So anyway, so people tend to buy it in multiples of 100. Since people buy it in multiples of 100, a lot more people can afford $2,000 to buy stock than if the share price was $200 and I needed to buy stock and I had to come up with $20,000 for one type of stock. So having it cheaper allows me to diversify my portfolio. So if I wanted to spend $20,000 on investments, I might be able to buy several different types of stock. So I want to keep it in this range simply because I want more buyers, and to have more buyers, I need to keep the stock price in a range that people can afford the stock. And so what happens if the share price, let's say Apple has done this, so let's say that a share price starts at 20 and it goes up and up and up and up, and suddenly it hits $200. Now again, people are going to have to buy it at $20,000 if they're going to buy it in multiples of 100 shares. So what I do is I split the stock. So let me make it go up to 40 or 80. I'll make it go up to 80. Okay. So I have it go up to 80. So what I do is I split the stock. And so I say, okay, everybody send in their one share of stock worth $80, and I'll hand you back 2 shares of stock. So immediately the market goes down to 40. Okay, and so now where they had 1,000 shares of $100 par common stock, you now have 2,000 shares of $50 par common stock. There is no entry for this. You simply do it in the notes to the financial statements, and this is like a subsection of the balance sheet. So this is before and this is after. So now everybody has 2 shares of stock with a par value of 50. The market value is 40. I got some problems there with my par being below market, but anyway. And then if it keeps going up again, I can split it again. So sometimes you'll see some really weird par values on stock, and it's usually because it's split. And when I say split, it doesn't have to be a 2-for-1 split. It could be a reverse stock split of 1 for 2. If the share price gets really low and you want to bump it up, you can take back 2 shares of stock and hand them 1, because you don't want to appear cheap. You don't want to be on the penny stock market if you've not been there. But you can also have a 5-for-3 stock split, a 4-for-3 stock split, whatever you want to do. This one's a 2-for-1 stock split. So it would increase the number of shares accordingly and decrease the par value. So again, no journal entry made. All right, so now, I don't know why it goes back to, I guess we're going to talk about large stock dividends. Large stock dividends are similar to stock splits, but they're 20 to 25% or above. So I guess you could have a 100% stock dividend and be the same as a stock split. But you do make a journal entry for it. You just use par. And I said that one before, so I'll go through this one really quickly. So we have a 30% share dividend on payable to stockholders. Notice it's a share dividend, so read them carefully to make sure you know that it's not a dividend on shares. It is a share dividend. So what we're paying them are shares of stock. So I have 100,000 shares, so 30% of that is 300,000 additional shares. Okay, I have 1 million shares, 30% of 1 million is 300,000. And so I'm going to debit common stock dividends distributable for the 300,000 shares times $10 par, and I credit common stock. And I kind of just made that entry up here. Okay, I could care less about the $200 per share fair value because this is a large, it's above 25%. I'll never give you the 20-25%, or I may give you the 20 to 25% and give you 2 things, and I'll say assume they consider it small, assume they consider it large, and make the 2 journal entries. One, I use market, small. Above 25%, I use market or par. Okay, so it's 30%. There's my par. Okay, small, par, large, market. And I said that backwards. Large will use par, small will use market. Why? Because if you give so many more shares, the market is plummeting. So this $200 doesn't mean a whole lot. Okay, so there's your entries, and then when I distribute the dividends, I'll see if they make that one. Nope. So when I distribute them, so I'm going to debit common stock. Oh, here it is. Where's the one for the data declaration? Okay, so the first one, please make sure you do the first. Oh, there it is. I debit retained earnings, credit common stock dividends distributable. Okay. rewind this and correct what I just said. Debit retained earnings, credit common stock dividends distributable. This is the date of declaration. This is the date of payment. All right. Clear that. Go on. Okay, next one. We're over here. Presentation. Presentation, you always do capital stock, then additional paid-in capital, then retained earnings. Capital stock, additional paid-in capital, retained earnings. Sometimes you have a separate heading kind of out there. The less treasury stock would go out there. So I sometimes remember it as capital stock plus additional paid-in capital, next retained earnings, and then other stuff. Okay, and you're going to find out we have some other stuff here. So in the order of capital stock, preferred always comes first, common always comes second. Then remember I said before that common stock dividends distributable was an owner's equity, so it comes third. So for first preferred, second common, last common stock dividends distributable. If you had more than one class of common stock or preferred stock, you would just list them, all the preferred first, all the common second. Then comes additional paid-in capital in the same order, preferred first, common second. And then sometimes you'll have additional paid-in capital from treasury stock, those type of things. So then I have retained earnings. So notice this is, I don't really like this because this is not a heading for the other one. Okay, so I would have put these out here. Okay, so we have total paid-in capital and retained earnings, total paid-in capital and earned capital. Then I subtract cost of treasury stock. So make sure you know this is a negative. I usually put brackets around it. This accumulated other comprehensive loss, that's the when we said things go to OCI or AOCI in owner's equity. So if I had a gain or loss on available for sale securities, it goes to owner's equity. So that's this. So if it was a gain instead of a loss, it would be positive. So then I have my total stockholders' equity. So that's presentation issues, capital stock, then additional paid-in capital, then retained earnings, and last other. Within capital stock, preferred, then common, then other. Within additional paid-in capital, preferred, then common, then other. Have my retained earnings, and I subtract out treasury stock, and then I'd add or subtract some other stuff, depending on whether it's positive or negative. Okay, so you might disclose any restrictions on retained earnings. So if you had we talked about it, a bond covenant before that said I had to keep an amount on hand in retained earnings, you would disclose those in the notes to the financial statements. Sometimes you also have regulatory bodies come in and say you have to keep a certain amount of retained earnings on hand. This is just like the other one, except notice this is beginning plus additions gives you end. So this is the number, let's look at retained earnings. Beginning plus net income minus dividends gives you ending. And then I have this weird little $1 thing for stock option plans, but we're not going to talk about that. Then I have accumulated other comprehensive income or loss. That's the gains or losses on available for sale securities. Beginning plus additions. Trying to find my, right there. Unrealized gains on securities. Oh, they have 0. Okay. So right there is that adjustment on available for sale securities. In advance, you'll learn about translation adjustments, and then derivative adjustments are also investments. And then we have some other things. So this is the big one right there. That's the one I expect you to know right now. Okay. The available for sale. So again, I take all of my stockholders' equity and I do what is my beginning plus additions minus subtractions equals ending. So there's my beginning of the year, there's my end of the year. So notice, clear all that. If I had preferred stock, I would put them right before common stock, so it goes kind of in the kind of same order, although they flip treasury stock and the AOCI. All right, next one. Okay, some ratios. Okay, so we're going to talk about 3 ratios, the rate of return on common stockholders' equity. So whenever you see return always means net income. Okay, so we're going to see net income basically divided by common stockholders' equity. When you have a return on assets, it's net income divided by assets. If you have a return on sales, it's net income divided by sales, etc. So whenever you see return on, expect net income. But notice this is also common stockholders' equity, and we know sometimes preferred gets stuff first. So if you have a preferred of any of these that are for common stockholders' equity, we're going to subtract out the preferred. The payout ratio, so if you think about your beginning retained earnings plus net income minus dividends gives you ending. This is basically if I have $100 in net income and I pay out a dividend of 60, I'm paying out 60% of my retained earnings as dividends. Okay, and again, we might have a little bit of different over here if we have preferred shareholders. Okay, because you're not going to pay out a dividend to common shareholders. And then book value per share is simply just that, which I'll get to in a second. Oops, let me delete this stuff. Okay. Next one. So, return on shareholders' equity is net income divided by average common stockholders' equity. So, net income, but sometimes I have to pay preferred dividends, divided by average stockholders' equity. You get average by taking beginning of the year plus end of the year divided by 2. So, I don't know if any of your homework has average, but it's 2 ways you can do it. Beginning of the year plus end of the year divided by 2, or last year plus this year divided by 2. They're exactly the same numbers because last year at midnight on December 31st is the same amount you would have on January 1st at 12:01. So whichever way you want to say it. So in this case, I have net income of $360, declared and paid preferred dividends of 54. So this is income that is going to common shareholders or is available to go to common shareholders, and I divide it by my average common stockholders equity, not preferred, just common. Okay, so that's why it's important to keep your additional paid in capital separate. Next one, what about my payout ratio? Well, my cash dividends were $100,000, and I take my net income minus the amount, and this is cash dividends paid to common shareholders, by the way. So cash dividends paid to common shareholders divided by my net income minus my preferred dividends, which in this case are 0. And so I have 20%. So I paid out 20% of my net income. Next one, I have common stockholders at book value per share is simply what is on my books for my common stockholders equity divided by number of shares. So this one, the amount shareholders each would receive if the company were liquidated on the amounts reported on the balance sheet. Here, they aren't. Amounts are never the same as are on their balance sheet because your land could be at what you purchased for it, etc. So don't put much stock into this. It's just you can compare it to last year, you compare it to another company, etc., etc. So don't take it that you're going to get $10 a share if it's liquidated. That's only if the assets were worth what they're on their books for. Okay, last page we're going to do is we're going to talk about dividends. Okay, so when you do these dividends, remember you don't have to pay a dividend. Okay, so 2 important terms you need to know are what is cumulative. Cumulative means the dividend accumulates. And what is participating? Participating means you get to share. So if it's non-cumulative, it doesn't accumulate. If it's non-participate, you don't participate. Okay, so and this only talks about preferred stock. So preferred stock is either cumulative or non-cumulative, and participating or non-participating. So set it up kind of like these right here. And get to it. So what I do first is they distribute $50,000. So go down here and write down the $50,000 that they're going to pay because I want to total up to that. And that isn't really that big a deal in this one, but it'll help you later. So set up preferred, common, and then set up the 50. Okay? So I'm distributing $50,000 as a cash dividend. Its outstanding common stock has a par value of 400, and its 6% preferred stock has a par value of 100. So first thing you need to do is figure out how much dividend am I going to pay the preferred. And this is the 6% is always the percent of par. So first thing I'm going to do is say 6% of par is $6,000. Okay, so I'm going to give the preferred $6,000 before I give the common. This case, it's non-cumulative, which means it doesn't accumulate. So remember, you don't have to pay a dividend. So if I decide to not pay a dividend, next year, do I have to pay the preferred last year's $6,000 before I pay the common? And the answer to that is, it depends on whether it's cumulative or non-cumulative. So this is non-cumulative, so I don't care. So I pay the preferred 6, so write 6 there, back into the 44. If it's non-participating, it all goes to common. So that one should be easy. Holler if you have any questions. Next one. This one, remember that if it's cumulative, the dividend accumulates. So I have 6% preferred stock, so I owe them $6,000 a year, and I have not paid the preferred stock in the 2 preceding years. So I owe them 2 years past and the current year. So since it's cumulative, I have to give them $6,000 a year for the 2 years in arrears. So I give them 12. I usually write the 12 over there. Again, I've got the 50 down here. And then I look at that and say, do I have enough for my next step? Because if I only paid out a dividend of if I only paid out a dividend of 10, 10 goes to preferred, nothing left for common, and I paid 10, so I have 2 years of dividends and arrears for the next year. So I still have enough left, so I go to my next step, pay the common, the preferred their current year, so I give them 6,000, 12 and 6 is 18. I still have some left. Plug in that remainder, and since it's non-participating, it all goes to common. So that's that one. Okay, so next one. What happens if it is non-cumulative and fully participating? Okay, this one I do a little bit different than they do, but anyway, so I'll show you in just a second on a spreadsheet. Okay, so I got a current year dividend of 6%, so I pay them 6%. I usually leave that on a line in and of itself. The next thing is I pay the common shareholders an equal percentage. So notice this is 6% of par. 6% of par. So I give the common shareholders 6% of par. So if you go back to one of these up here, notice that the par value of the common stock is $400,000. Okay, so I'm going to give them 6% of $400,000. So I usually put that on a separate line. So common shareholders also 6%, so they get $24,000. Okay. Again, I kind of do that because I always check over here and say, do I have any money left? So if I pay $6,000 to preferred and I only pay out $12,000, then the common only get the other 6. So once you run out of money, you stop on this. So 24 is 6 is 30, so I still have some left. Plug that 20,000 in there, and now I'm going to participate. What they do to participate is take 20,000 divided that's left, divided by the 500,000 par, 100 for the preferred, 400 to the common, and say then I get 4% of par, so it's 4 and 16. So remember that there. I do it a little different. I'll see if I can bring up a Excel spreadsheet here. Pause it. Okay, so if you recall, I want to pay $20,000 of dividends out. Okay, and I have par of the common and I have par of the preferred stock here. And so that totals up to be 500,000. So what happens is I simply say, okay, what goes, whoops, I think that's preferred and that's common. Okay, and so I say, all right, well, 1,000 out of the total par, so 1/5 of the dividend goes to the preferred, and 4 of the 4/5 of the 20,000 goes to the common, so I get 4,000 and 16,000. So that's generally how I do it. So notice they get 4,000 and 16,000 too. I just do total that. So 1,000 over 500,000 times the 20,000, and 400,000 divided by 500,000 times the 20,000. Okay, so the next one is what happens if it is cumulative and fully participating. And honestly, the steps in that one are exactly the same as the steps in the previous one. I first give arrears, except that I first give arrears. So I have 2 years in arrears, so I have 12,000. Again, I'm going to write the 50,000 down here and bring the 12,000 over and note, gee, I have some left, so I'm going to go to the next step. So the next step, I'm going to give the preferred the current year is 6,000. So I'm going to bring that one over here, and so now I have 18. I still have some left, so I'm going to go to the next step. Then I give their common, their matching 6% of par, which is 24,000. So now I have 12 plus 6 plus 24, so that's 42,000. So I still have 8,000 left. So now I'm going to write the 8,000 down there, and I'm going to go back to my spreadsheet. And instead of sharing 20,000, I'm going to share 8,000. So I have 1 over 5 times 8,000 is 1,600. 4 over 5 times 8,000 is 6,400. So you can see I give 16 and 6,400, so for a total of preferred, total of common. So one last thing that the problem may ask you is how much did you give them per share? So I would divide by the number of shares. And this one I don't know how many shares because it doesn't say the par. I just have the dollar value. Okay, and that's it.